Wonderful. Then we will get started. Welcome. Good to
Thank
see
you.
Hi.
Hi, great to see you
Good
guys.
to see you too. You're back from.
I am back from maternity, yes.
Yes.
I have a 6-month-old, if you can believe it, little girl. I was just telling them she went on her first swing ride yesterday. Loved it. Has 2 little teeth. I'm like, what is happening? Are you a teenager already? It's gone by very fast, but it has been very fun. She's sweet. She looks nothing like me. She looks just like my husband. I'm still waiting for the blonde hair, but I don't think it's coming. But that's okay. She's very cute. It's been very fun, but it has been great to be back and great to see you guys again. With me today is John Forelli, who most of you I think know, but just in case, a little refresher. John is our head of portfolio research and has been with Boston Partners now for 13 years. Before he joined us at Boston Partners, he spent 12 years as a portfolio manager, and then also before that was a research analyst. He's covered healthcare, chemicals, capital goods, and industrials, and John has over 40 years of industry experience. So you're in great hands today. He'll review the portfolio and the performance and what's going on in the current market. And then a new face for you all today. So I brought with me Connor Watson. Connor joined Boston Partners this summer after 10 years at BNY Mellon. And he joins Bill Supple, who some of you may know from the past. Bill is our director of Taft-Hartley and Public Funds, and Tim Strakosh is another new member of that team. And they form a new dedicated team here at Boston Partners that are focusing on our public and our Taft-Hartley clients. And Connor now has over 11 years of industry experience, and he has been focused primarily on public plans such as yourself. So Connor and that team will now work with you all directly. So they're going to cover your account here at Boston Partners. So we have reorganized our client team a little bit. So I will focus now on our corporate and religious plans. So I won't be attending meetings anymore, which is sad. I've been with your account since I started here at Boston Partners back in 2011. So I've been with you guys for a long time, and it's been really great, and I've loved coming down here, getting to see you all, getting to know you all. And I'm still with Boston Partners. Coincidentally enough, I sit in between Connor and Tim. So if you ever need anything, if you need to find either of them, I can knock on their wall, I can throw something at them.
Yes.
But it's been great. So we've kind of really focused this dedicated team to work on accounts like yours with public plans. So I will kind of turn it over to Connor. I can let him expand a little bit about the team, and then he'll give an update on the organization, on the team here at Boston Partners before turning it over to John. But you guys are in great hands with Connor, and I'm still here, so you'll still see me, you'll still hear from me, and I'll send some baby pictures here and there.
Thank you. Thank you, Liz. I know I have big shoes to fill, so I hope I can live up to those expectations. I don't come with a cute baby daughter, but I have one on the way. In March, I'll have a daughter of my own, which is very exciting. But as Liz mentioned, I spent 10 years at BNY Mellon, started at Boston Partners earlier in July. The sort of pod, as we're calling it, made up of Bill, Tim Strakosh, and myself, are covering all of our public and Taft-Hartley plans across the country. It's about $10 million in assets, and I only bring that up to say that it's a well-resourced team. It's important. It's an important market segment for Boston Partners, making up about 40% of their institutional business. So we're going to make sure that you are serviced as in the high quality that you deserve. So look forward to doing that, and look forward to working with you all. If there's not any questions on sort of the team change there, we can jump into the book. On page 1, you'll see Boston Partners at a glance. This is familiar territory for you all, but Boston Partners was founded back in 1995. We're predominantly based up in Boston with most of the company there, but we also have a presence in New York, LA, the Bay Area, and London. Assets as of the end of the quarter were $88.6 billion for the premium equity strategy, which your portfolios utilize, Assets were at about 10.6 billion there. The next page, you'll see the performance of our equity strategies compared to their benchmarks. So each of these numbers is how they compare to the benchmark performance. Green means we outperformed, red means we underperformed. You'll notice it's all green boxes here. Boston Partners has been able to see strong outperformance compared to their benchmarks, and that's on a net of fees basis, which is certainly important as well. Premium equity, which you all use, is the second row down. You'll see since inception, it's been beating the benchmark by 2.82%. So certainly a good choice there. We're happy to be able to deliver that for you all. The next page, the research, the investment teams on the left side, to the portfolio managers as well as the portfolio research team. Julio Ramallo, who is the portfolio manager for premium equity, halfway down on the left. He's been with the firm since 1995, the year we were founded, and he's been a portfolio manager on premium equity since 2005, when you all started with us. John Forelli is also on that page, head of portfolio research group. Seasoned veterans here with us today. We have the analysts here in the middle box, the purplish box, if you will. The story here is also folks who have been doing what they do for a long time, and they're very good at it. The average industry experience is 18 years, average of 10 years with Boston Partners. There's no major changes to report on the Boston Partners front, no planned changes. The only one I will mention is actually an addition to the analysts, Jet Ziyama, who is a first-year analyst working in banks and the financial services at this time. I just highlight him because he's a really good example of how we like to develop talent at Boston Partners on our investment teams. This is someone who's recently out of school but has proven himself to be talented and ambitious. So we love to bring in new faces and pair them with experienced analysts so that they can learn the ropes, learn how we invest at Boston Partners. In this case, he's working with Kevin Duggan, who has 28 years of industry experience and 18 years with Boston Partners. So he's certainly in good hands, and we hope to see good things out of Jet. Are there any questions about the firm? No? Okay, well then, great. I can hand it on over to John here, who can start with taking us through some performance and what we've seen in the past quarter.
Great, thanks, Connor. And the next couple of pages has a lot of numbers on them, and I'm going to start talking about some numbers that aren't even on this page. So just, I noticed just last week that they started showing returns for some of the endowments for colleges around the nation. And I saw that the average endowment last year had a return of about 6.4%. This is your fiscal year ending 6/30, so this is the quarter before now. Your return was 7.4%, so you beat that return, which was nice to see on an average basis. And then I noticed that some of the colleges like MIT, their endowment was down 2.9% last year. Duke was down 1% last year. These are accounts that have been taking advantage of some of the expensive stocks that are in the marketplace that we get a little fearful of here as value managers, and it's just a reminder of how we can help protect your capital in poor market environments. We might not be able to keep up with those heady returns in those go-go years, but if we can protect your capital in poor markets, then it's usually a pretty good way to keep our folks happy over the long time. And you've been with us for over 15 years, and we've had many clients with us for 20, 25 years at Boston Partners. So bring it back to home on page 5 here. For the third quarter, we did have a negative return. There was really no place to find a positive return in the equity or fixed income markets last quarter. The S&P 500 was down 3.3%. The Bloomberg aggregate index was down 3.2%. We were down about half that, about 1.6% on a net of fee basis for your accounts, beating the benchmark by about 1.6% for the quarter. When you look for the year, we have eked out a modest positive return year to date, about 1.6% positive return compared to about 34 basis points for the benchmark. So again, about 125 basis points or so ahead of your benchmark. And then on a one-year basis, you can see the next column over, 10.8% return relative to about 7.5%, so about 3.3% ahead of the benchmark. And if you break it down by, where were the sources of that return, our superior stock selection within equities added about 230 basis points of excess return. And the fact that we were overweight equities relative to fixed income last year added about 100 basis points of return. Those are kind of round figures, but just give you an idea of how that worked out for the year. And I think that one of the most interesting things of all the numbers on this page is that fixed income last year, although the Fed started raising rates and people were very attracted to 5% fixed income returns for the first time that they've seen in many, many, many years, fixed income had barely a positive return last year, while equities, our equity returns were over 18% last year. So that's what makes this business difficult, fun, challenging, is that what you think's going to happen, what looks like a slam dunk, let me go put my money in 5% money market accounts, wasn't necessarily the best place to put your money over the last 12 months. And we try our best to find good long-term investments for you folks. We're not really trying to time the market on a year basis or at a quarterly basis. We're just trying to find good securities for you folks for the long term and have an asset allocation that we think makes sense relative to the opportunity set in the marketplace. Okay. If you turn on page 6, you can see very similar returns to the police as well. The first page was for the town, but very similar returns. We run clone portfolios, and no difference between the portfolios themselves. From an asset allocation standpoint on page 7, first of all, you can see that we manage about $101 million for the employees and about $57 million for the police. And you can see our equity allocation. We can max go up to as much as 60%. Today, we've brought that back down over the last year to about 56% allocation to equities relative to fixed income. As those rates in the fixed income market have come up, they do look modestly more attractive, but we still favor equities over fixed income in this environment because basically you have a growing dividend stream of earnings while you have a fixed income stream in fixed income, and we really would need to see higher interest rates to become more attracted to fixed income, but as it's gone up, that has become more attractive to us over the last year. Altogether, for all of your funds that we manage for you, including the OPEB accounts, we manage about $170 million for you. Today, there's about $95 million in equities and about $75 million in fixed income for all of your accounts. Just to give you an idea here for how your assets have grown on page 8.
John, can I ask a quick question? The
Yeah.
asset allocation decision, how much of that was sort of natural progression, leaving it alone? And how much was like an active move, positioning it?
Yeah, so we have an active portfolio review of our portfolio positioning relative to fixed income from an asset allocation standpoint. Mike Mullaney, who has a fixed income background, and coincidentally, so does our CIO, Jay Feeney. So even though we don't manage fixed income in-house, we definitely have a view towards fixed income. So it is an active decision. When interest rates were zero, it was pretty easy to think about being maximum overweight equities relative to fixed income. Now that we're seeing real interest rates out there, we're shading more towards fixed income, so it is an active decision. And it's been, being overweight equities relative to fixed income has been the place to be. I'd say, quite frankly, we're probably biased more towards equities rather than fixed income because long-term equities return about 10%, fixed income returns about 6%. Yeah. So in a steady state environment, I think we would typically be a bit overweight equities relative to fixed income. You also have a fairly conservative balanced or bogey here at 50-50, tends to be pretty low relative to some other funds out there that are typically more like 60-40 would be a normal allocation.
Standard one.
Yeah, so does that help?
Yeah, no, I was just thinking, we had a year where we had such disparate returns over the last 12 months. Sometimes you just have an asset allocation drift that turns out to be great.
Yeah.
But you just left it alone, and that's where you ended up.
What I would say is first of all, if we ever go, if equities outperform, we will always bring it back down to that maximum level. Right. So that's something that we do. probably not monthly, but quarterly, where we'll bring it back down. And then, this past 12 months is probably the first time we brought our equity allocation down below 60 in 3 or 4 years.
Right.
Longer than that.
Yeah, it might be a little bit longer than that. It might be, I'm thinking 2018, we were 60%, that's 5 years ago, right?
Yeah,
So
right.
it's been a while. On page 8, you can see how your assets have grown over time. You were initially, for the pension fund, entrusted us with $26 million in assets. You've since taken out about $3 million, and you've had investment returns of $78 million. So you have $101 million. You've made more than 3 times your initial investment so far over that 18-year time period. And if you look at the town as well, $23 million. Taking out $22 million, even a net investment of $1 million is now $56 million. It's a pretty nice return. If you look at total return, we've returned about $78 million on an initial $23 million investment, again, over 3 times your initial investment back in 2005. Page 9, very similar returns that we saw on the previous pages. This is for the OPEB funds, which now equal about $11.6 million in total. Using the same portfolios to create those returns. Page 10 is just a quick idea of when you initially invested with us, we invested about $30 million in equities between the employee account and the police account. So this just shows what that $30 million would have done if it just stayed in the portfolio, which is fairly close to what's happened with the town employees fund, because you haven't taken much money out. But that $30 million would have grown to about $193 million. That's over 6 times in the initial investment. While if you had put it in the Russell 3000 Value Index Fund instead, you would have done well. You've had about $110 million, but we've created about $83 million of excess returns net of fees over that time period. Any questions on, I just gave you a lot of numbers. I felt like we just gave you a math lesson there or something, but we all good? Okay. Page 11, we can see the what we do for a living, and I think most of you folks are familiar with it, but when we create portfolios, we're looking for portfolios that are less expensive than our benchmark, have higher quality or stronger business fundamentals, and also have improving business momentum. And if we can create portfolios with those 3 characteristics, we think we can create pretty consistent returns for you over time. We're not going to beat our benchmark every year. That's certainly our goal. But if you give us a 3-year rolling time period, 80% of the time or so, we're ahead of the benchmark. So what we do, it works. Connor showed you earlier, it not only works for the premium equity strategy, but it's worked for all of our strategies at Boston Partners. We use this same approach for all of our client portfolios. On page 12, you can see how the portfolio is positioned today from a characteristic standpoint. Within that valuation circle, the second ratio down, PE FY1. That means the expected PE ratio of the portfolio based upon expected 2024 earnings. So 12 times earnings compared to 13.2 for the Russell 3000 value, and certainly much less expensive than the S&P 500. With really, more than double the free cash flow yield of our benchmark. So free cash flow yield is very important. We try to find companies that are generating lots of cash flow, and then companies that have used that free cash flow wisely, reinvesting in their own businesses, but not over-investing such that they're kind of wasting money and their returns begin to roll over. We like to see them increase their dividends, repurchase shares, pay down debt. There might be more difficult economic environment sometime over the next 12 months. Clean balance sheets will be very important. And if any of our portfolio companies makes a significant acquisition, we'll make sure that our analyst who's responsible for that sector and industry takes a good close look at it to make sure we're not being diluted over a multiple year time period. We certainly understand companies have to invest in growth. A couple of quarters of dilution due to investing in growth is fine, but if it's a couple of years of dilution, it would probably encourage us to look for another position for your portfolio. Fundamentally, very strong portfolio today, operating return on assets and returns on equity, very high relative to our benchmarks. Just today, very good quality in this portfolio. All value companies look relatively inexpensive compared to the entire market today. So during these times, we take advantage of that and we create a better quality portfolio because we can buy lots of companies that lower prices, and we might as well increase the quality of your portfolio, really buying some companies that we wouldn't normally afford to be able to buy based upon our disciplines. On page 13, you can see how we're positioned today relative to the benchmark from a capitalization standpoint. As a reminder, this is an all-cap portfolio. We evaluate about 3,500 companies on a weekly basis to try to find the best ideas for your portfolio. Today, we're finding more opportunities in mid-cap, which is nearly 50% of your portfolio today, which is overweight relative to the benchmark, at the expense of large-cap companies today, which the biggest companies tend to be more efficiently priced. There's a little bit less opportunity to find outsized returns there. The mid-cap portion of the market is really a good combination of better growth at an attractive price relative to other portions of the market today. And then small cap, we have about a market weight there in small cap. Today, both small cap and mid cap look inexpensive. We would, on the margin, rather own mid cap companies because they're less risky than smaller cap companies. So if they're trading at similar valuations, we'd rather have a bigger, more established company in the portfolio. On page 14, we can see how we're currently positioned within the portfolio. The top 10 holdings make up about 19% of the portfolio. This is a relatively diversified portfolio. We typically run this from anywhere from 120 to 130 positions in the portfolio. We believe in owning these companies that have those characteristics. That's what's going to create the excess returns for you. We know one thing for certain, and that is we're going to make a couple of mistakes every year, a handful of mistakes. We'd rather own more companies rather than less companies so we can diversify away the mistakes in the portfolio. And I think we've done a decent job of that over the years. We typically protect capital pretty well in poor market environments. On the right-hand side of the page, you can see where we're seeing more opportunities from a sector standpoint. Your portfolio is in the blue bar. The green bar would be the Russell 3000 Value Benchmark, which would be our primary benchmark. As you go down that list, you can see areas of underweight would include consumer staples, real estate, and utilities. These three sectors make up about 16% or so of the benchmark. We have less than 2% of your portfolio in those sectors, and that's because they just look expensive to us relative to other opportunities out there. We're not going to force ourselves to buy what I'd call the best house in a bad neighborhood. We're just trying to find a bunch of good properties for your portfolio. So those are just areas that we are not really very exposed to today. Higher interest rates tend to put pressure on the prices of the higher dividend yielding securities such as utilities and real estate, and they have underperformed this year as well as consumer staples.
Is there any upper limit as to how much you will invest in any one sector?
Yeah, so one sector, no more than 35% in any one sector. Typically, you would not expect us to own more than 10% above the benchmark weight. It's not a hard and fast rule, but we, again, very much believe in diversification, so we want to populate your portfolio with different types of companies that will give it different types of returns. And today we're finding particular opportunities within healthcare. We like those companies a lot more than staples or real estate or utilities. They tend to all be relatively stable businesses or predictable businesses in a good economic environment or poor economic environment. All four of those sectors typically are pretty stable. We're just finding much better opportunities within healthcare. Health insurance companies are populated in this portfolio, as well as pharmaceutical companies and biotech companies. Generate very good free cash flow. Growth is a little more difficult for the pharmaceutical companies because they've got some drugs coming off patent, which creates a little bit of a challenge for those companies. But in the meanwhile, they look very attractively priced, and their earnings and sales are growing, just maybe not quite as much that it would attract the growth investor who's willing to pay a lot more money for growth. Feel very comfortable with those holdings in the portfolio. Technology is also an overweight in the portfolio.
Yeah, I was just wondering on the utilities thing, because there's enough people out there screaming they're so cheap now that it's finally gotten far enough. And granted, people scream all day.
Yeah.
A lot of things. I'm just wondering whether is the utilities just a value trap at this point? And that there's no growth in them, therefore Doesn't matter, it's just a yield play and you get your
It's,
yields
you know,
elsewhere.
that basically, for so long, there was no competition for their yields.
Right.
If you wanted a short-term yield, buy a utility.
Tina.
And maybe the utility company is really worth $20 a share, but you're willing to pay $25 a share because it's giving you 3% dividend
Right.
yield, right? Today, there's a lot more competition for that yield. So it's, for us historically, we're used to paying 12 to 14 times earnings for a utility. And for the longest time period, they were trading at 17, 19 times earnings. They've come down to about 16 times earnings, but still look expensive to us. I would say if we knew the 10-year bond yield was going to 3% next year and
Oh, yeah.
the Fed was going to cut rates in half, utilities will do fine.
Yeah, you also want to buy growth stocks. And
Yeah, there's a lot of other things you want to buy, exactly.
and the FANGs again, and
yeah.
everything else, so.
In this environment, the market has rewarded lower valuation and it has rewarded higher quality. And utilities, from a quality standpoint, they have very leveraged balance sheets, so they don't win out there. And from a valuation perspective, they look expensive relative to history, so they're kind
Just not
of
there yet.
caught in between.
All right.
Technology, we are overweight there, but not the names that you'll see Jim Cramer talk about on his show. We own contract manufacturers. Jabil and Flex, companies you probably don't even know, but they're companies that they basically contract manufacture for other technology companies, and they're improving their margins by a little bit, which is making their cash flow grow very nicely, and they're trading at 10, 11, 12 times earnings, and they're buying back lots of stock. So it's a good, safe place to be, we think, in this environment. We also own some semiconductors in the portfolio as well. Industrials, consumer discretionary. At the beginning of the year, we were overweight both those sectors, a little bit more so than we are today. We have cut back those positions. But at the beginning of the year, many investors were anticipating a recession in 2023 that we still haven't seen come yet. We don't position our portfolios based upon our expectation of what's going to happen with the economy. We're not very good at that. We'll let the economists try to do that and the strategists. What we think we're pretty good at is deciding whether consumer discretionary stocks look more attractive than financial stocks or real estate stocks in your portfolio. So we try to focus on relative valuation. So from our perspective, it looked as though those economically sensitive sectors were already kind of pricing in a recession that hadn't come. So even if the recession came, it didn't seem like there was that much downside in many of those names, particularly housing-related companies. NVR has done very well this year, which is one of the high-quality home builders. And then Tempur Sealy, which is a mattress manufacturer that had some missteps last year, have finally got their kind of manufacturing act together this year and has seen some good earnings growth. Anyway, just give you an idea of where we're seeing opportunities in the marketplace today. It's a little bit of a different group of companies than if we were a top-down investor and we're telling you about how would we position your portfolio if we expected a recession sometime in the next 6 months. To tell you the truth, we don't know whether there's going to be one or not. And if there is, we think we're pretty well positioned anyway because we have a very high free cash flow yield portfolio that should help protect on the downside.
John, before we move on to the next page, on the turnover, because I noticed that the number is not there, I was just curious because you mentioned that you've been taking advantage of this market. So is it higher than it historically
It's
has trended?
been running pretty low here for the last year. I'd say turnover's probably been about 15% for a year. We typically run turnover in the 20 to 35% range for this portfolio, so it's been a little bit on the low side. We've been happy with the positioning of our portfolio. When companies get too expensive, we're happy to cut them back. We haven't sold too many positions outright. We've done a few this past quarter. We've had the opportunity to add some companies that are typically too expensive in this portfolio. That's where we've been kind of take advantage of the opportunity. So Visa is in this portfolio. Typically trades at 25 times earnings. You wouldn't find a company in this portfolio typically at 25 times earnings. About 6 months ago, it went down to about 18 times earnings during when SVB went bankrupt. Like all financials, went down. It's like, okay, well, Visa, let's take advantage of this opportunity to buy Visa. They don't have any credit issues that a regional bank might have. This past quarter, we just bought Matchmatch.com, which is really a great cash flow generating company. The growth investors have kind of moved away from it a little bit because had been a very fast growing business that is slowing down a little bit, but a huge cash flow generator. And it surprised me when I started looking into the fundamentals of the company. They have almost 50% of their sales outside the U.S. I thought it was kind of a U.S.-centric company, but it's global. So anyway, there's an opportunity if, it's a good business.
Does it have something to do with the relation between single people looking for dates and interest rates?
Yeah,
There must be some
exactly.
sort of correlation.
And maybe you've got to get matched up now because you can't afford mortgage rates anymore. They've gone up. So if you have two incomes, you might have a chance now. Pages 15 and 16 just give you an idea of our portfolio holdings with color coded by what we've sold and added in the most recent quarter. Orange would be eliminated from the portfolio, green would be added to the portfolio. And you can see relatively low turnover for the quarter. Activision was sold out of the portfolio. Finally, their deal with Microsoft went through. We were very patient with that name because there was a lot of ARB spreads there. It didn't look like the deal was going to go through, and then it went through and ended up making a good return on that company. Page 17 just gives you an idea of how we've done in different market environments. So over the last 15 years, in down markets, in months when the market's down, we've outperformed in 63% of those months. And in months when the market's been up, we've outperformed 56% of the time for an overall batting average of 59%. I guess if you were an NBA free throw shooter, you wouldn't be too happy with 59%, but imagine if you could go to, Foxwoods with a 59% odds. You'd either have a very good night or you'd be escorted out early by the bouncers. I'm not sure which would happen first, but 59% is pretty good in the investment business. In fact, if we turn to page 18, where you can see how that ranks relative to our competition. This is a group of all-cap value managers in the U.S. looking over the last 15 years. Our returns of 10.5% puts us in the 10th percentile of all cap value managers. On a risk-adjusted basis, our information ratio puts us in the first percentile. So we're getting those excess returns by taking less risk than the average all-cap value manager. Again, running the diversified portfolios with the diversified characteristics that I described. And then finally, that batting average that I showed you before puts us in the first percentile again. So the consistency of returns has put us in the top. A different way of looking at the consistency of returns would be page 19. This is looking at our 3-year returns relative to our benchmark over the last 15 years. So over the last 15 years, there are 180 months. In 141 of those 180 months, we have been ahead of the benchmark and at an average outperformance of about 2.3%. And at the end of the day, we try to keep this business pretty simple. The best way to keep our clients happy, we believe, is to create excess returns on a consistent basis. And that's what we've tried to do for you. It doesn't mean every 1-year period we're going to outperform the benchmark, but hopefully, again, over these rolling 3-year periods, we'll be ahead of the benchmark and help your beneficiaries accumulate their retirement assets over time. Any questions?
Could you just describe your internal decision-making process of how you allocate to the sectors and then within the sectors specific stocks?
Sure. So it's all done from a bottoms-up process. Okay. So we start with about 3,500 companies that we evaluate on a weekly basis. Now we do that through computer models.
Sure.
So we measure each of those 3 characteristics of valuation, fundamentals, and business momentum. Mm-hmm. We give each stock a score for each of those characteristics. We have about 5 or 6 sub-models that define each of those characteristics. Okay. Big ledger, best combination of those characteristics all the way down to the worst. Then our fundamental research analysts will focus their time on the top 30% of that list for ideas for the portfolio. That's not broken down by sectors, it's just bottoms-up basis. So from the standpoint of today, we have more healthcare holdings in the portfolio than we do consumer staples in the portfolio. Not a top-down decision by portfolio managers or from a strategist at Boston Partners. It's just that we're seeing more opportunities on this screen on the top part of the portfolio for healthcare companies. Okay. So
who makes the decisions then?
So the decision is 100% Dulio Romalo's decision, who's the lead portfolio manager. That's how he gets compensated on an annual basis for his performance relative to his benchmark. We have a very collaborative information gathering standpoint. It's a room very similar to this. A table would be a little bit bigger than this. We'd have about 30 folks in our room, all of our analysts and all of our portfolio managers. And they'll talk about the ideas that they think are going to have at least 15% upside over the next year. Our analysts will then write up a report, typically about 5 to 10 pages, to convince the portfolio manager that it has those 3 characteristics that we're looking for. If Dulio decides that this is a stock that he might be interested in, he'll cut in touch with that analyst at the end of the meeting and say, okay, well, you want me to add Merck to the portfolio. These are the other 4 pharmaceutical companies I own. Which would you suggest I cut back? Collaborative process. He doesn't have to listen to what the analyst says. He can take that as under advisement for him. And at the end of the day, Dulio will make his own decision. Sometimes he'll sell a technology stock so that he can buy a healthcare stock, depending upon, if he has a technology stock that he's kind of itching to sell because it's exceeded his price target, he'll have somewhere else to put the money. So again, very collaborative process. One thing about Boston Partners, the culture is really good from a standpoint of all the analysts and all the portfolio managers are looking for the same 3 characteristics of all the stocks that we're buying. So there's never a debate as to whether we're looking at whether we're doing the right analysis. It's really a question of whether we can fit it into our existing portfolios or not. It's very different from other firms that manage value funds and growth funds and fixed income. If you have one analyst covering all of those 3 areas, it becomes, to one person you have to tell this story, to another person you have to tell this story. We're telling consistent stories at Boston Partners all the time.
How does I think I saw on the team the sustainability group, and perhaps I've missed it, but that seems somewhat new, at least in being represented in your materials. How did they impact the portfolio? Is it a totally separate strategy now, or are there certain screens, or how is that coming into play?
Yeah, it's a great question. So the ESG group has been around since about 2018. We've probably put it in our materials not more than 2 years ago. So you're right, it's new as far as highlighting it with the group.
It's now got a new color too. Green.
Yeah, and green for the sustainability group. We got the right color, I think. So we use that group, I'd say, 3 different ways. Okay, so for our normal portfolios like your portfolios, they will be doing environmental, social, and governance screening on these companies through the lens of we're trying to avoid having ESG type risks in the portfolio. So if we're investing in a company and they are a real bad environmental actor and they might end up getting fined by some government entity as a result of that, we want to make sure that our analysts and portfolio managers are aware of that. They might not be focusing on that portion of the risk of a company. So that's how it's primarily used in your portfolio today. And when you look at our models of how we describe different characteristics, our quality or business fundamental characteristics are closely aligned with good ESG companies. So there's already kind of inherently, we're buying high quality companies that typically don't have many of those risks that I'm talking about. We also have some clients that have social screening. Think of religious institutions that want to do certain things. The ESG group will help us find the companies that properly fit those screens and would no longer be appropriate for certain funds. So that would be kind of the second way we use ESG in our portfolios. And then there are some clients, particularly overseas, that's where we're seeing the biggest demand right now, where they want a ESG specific portfolio. So we want a portfolio geared towards the best ESG companies. So for that product, we'll look at all the securities that we own across the whole company, and we'll create a global portfolio with the best ESG characteristics of the stocks that we already own. So there are kind of 3 different ways. They do traditional, their own ESG research. We do look at screens from ESG providers, which give you kind of ratings on different ESG characteristics, but we really rely on our own ESG analysis. And for every company that we invest in, we'll do an annual review of their ESG characteristics to make sure that they're still being good corporate citizens.
Got it.
But for this strategy, there's nothing that says you're not going to invest in like a booze-filled gambling place that has good cash flow and a good business model.
Nothing that prevents you. So we own tobacco companies in this portfolio, for instance. But we don't want to own you know, we don't want to own BP right before the oil spill, you know, like, you know.
If you can call it.
Yeah, exactly. But, you know,
Yeah.
if we find companies that are lax on environmental spending or et cetera, that would be flagged.
So like liability.
Yeah, liabilities, yeah.
I know from time to time that brings up a question that I don't think we've asked in a while, just to get your feedback in terms of our guidelines. We don't have too many restrictions, but is there anything that has, I know years ago, like we had talked about international and SPACs, for example. Is there anything in our guidelines that are causing us to be different from what your unrestricted?
No, there's nothing in the portfolio. In fact, this past quarter, we added advanced micro devices to our portfolio, and we made it a covered call position there, which we don't do very often, but we do for occasionally. We have some clients that don't allow us to do covered call positions. You folks do. So, and we think it's a benefit. I think it's actually a way to invest in a risky security with a lower standard deviation of future returns. It's almost like you give away a little bit of the upside so that you can get a more consistent return over time. So. You allow us to do that, and that doesn't inhibit your portfolio. There's nothing in your portfolio today that would that we wouldn't own based upon your restrictions.
Any other questions? Any other comments that you guys had?
No, I think that's, you know, I'd say we're in an environment right now where, you know, growth came back in the first half of the year, and folks are getting, you know, a little antsy around that, you know, and we think that the portfolio is really well positioned today. As we've seen interest rates creep up here, particularly over the last month or so, I think we're starting to see some valuations come back down to normal, and the ability to protect capital, we think, will be particularly important over the next 12 months.
I had a totally ridiculous question that just occurred to me. I mean, I noticed this on page 30. You compare the current median PE to the historical average PE.
Historical average median PE, just to let you know. Historical average median PE.
Okay. Just wondering.
Yeah. No. We're not trying to play funny numbers here.
Little gimmickry there, but
Yeah,
okay, so
no.
it's the historical average median.
Average
All right,
median
thank you.
PE, exactly. And you can see on this page that the green bars above the blue bars for all growth companies, all growth portions of the
Right.
market, while in the value portions of the market, the green bar is below the blue bar. And you can see, particularly, I mentioned earlier, both mid-cap value and small-cap value look particularly attractive on a relative basis today. And this data is put together by Luthold Group. It's not manufactured by Boston Partners to make us look good or something like that. You know, we use an outside source.
Median average shenanigans.
Yeah. And the previous page might be just interesting to look at. I know you don't have a lot of different types of managers, but what page 29 shows is that if you're light green or dark green, it means the median manager has done more than 50% of managers have beaten the benchmark. If it's red, it means less than 25%. If it's orange, somewhere between 26 and 50%. And just by looking at this, you can see value managers have done a pretty good job of adding value versus the value benchmark. The difficulty in the market has been at the very top of this page, which would be large cap growth. And if you look at that number over the last 15 years, only 5% of active large cap growth managers have beaten the market. Because of that, some investors have concluded that we should just index, you know, because we can't beat the market, we can't beat those large cap growth companies, and it would be the wrong conclusion to draw. Value managers have continued to do well, even in this difficult market environment. And then, as you know, we've done, you know, top decile of all managers over that 15-year time period.
Great.
All right, well, thank you very much.
Thank you.
Thank you, yeah. Just like to reiterate again,
For everything.
very much look forward to
Always
working with
yours.
you all.
Don't be a stranger.
I will not.
And,
Yes.
I guess this is the first time I'm going to say this all year, but Happy New Year and Happy Holidays,
Yeah.
because we won't see you folks again until, I guess, April.
That's right, because we do our, that's right. We don't see you in January, which we do have on our agenda today. So if we go to the next item, it's really more of just a review, item 2 on the expenditures and the invoices. Were there any questions that anybody had? Any clarifications that they wanted to bring up? No? All right. Okay. So then that does bring us to what I just mentioned for the 2024 calendar. We have on one of the pages the proposed dates. At our last meeting, we had discussed doing half and half, doing half virtual and half in person, as a way to ensure that we always have a quorum. I guess given that it's still, this is October, and we're great, we got 3 and 3, but we scraped by. So, any feedback before we go to approve a calendar for next year on what you think might work best? I know last meeting I had mentioned that in January sometimes with the actuarial report, it's helpful to be in person. But open to feedback as to whether or not people feel they can commit to being here in January, or if virtual would alleviate some of that pressure. I know not everyone's here, but because you guys are here, you get the benefit of the input. Do people like the idea of 50-50, or would you like to go to 3-1, or?
50-50 is a good place to start, since we have been at 100% inch back. I think
Mhm.
January feels like the right in-person, because I think the actuary that, and I don't think any of these dates are particularly problematic, it's just, hit or miss, depending
I know,
on who's
it's-
here. It's not,
My personal vote is the summer one should be Zoom. I think
was
people
gonna
have
say-
different
That would be
vacations,
harder.
different times, and, yeah.
trade October for July. Or
If you want to do 50-50 still, yeah.
Yep.
I would put 2 Zooms. I don't know if you want to go 2.
Yeah, that's what we would do.
I mean,
is-
2 in a row, I'm sorry.
Oh, I see, yeah. I mean, I'm okay with going 2 in a row after having gone through COVID and having done a bunch more than that in a
Yeah.
row. I think we can handle it, and I think that we'll be online, and so it'll give people the opportunity to dial in, but then also we will have a visual. So if people are comfortable with that, I understand the summer, and so we could swap it. Do people feel that there's a preference with regard to when we would see, because the one that we would do in person, we'd see Boston Partners. So April or October is a better time to see them in person.
April seems a little early in the year.
Okay. Well, it's late in our plan year,
Yeah,
so.
that's true.
Because I'm trying to think, when do we usually get asked to review with the, well, in January, what the proposed contribution is, and then we have to vote on it, April, is it usually? So I'm trying to remember.
I don't know.
Or just to.
It'd be in
propose.
January, because then it'll flow into the budget
It does.
process, yeah.
Okay, so that's what okay, so that doesn't matter then. All right, so why don't we swap July and October? How does that sound to everybody? Unless people want
In person
April.
in January, we're Zooming in April and July, and then we're back together in October.
Mhm. Unless people feel the fall is busy, and so therefore we just swap it. Just, it's a choice between April or October. I don't have a preference personally.
I'm indifferent on those 2.
Totally. For the police, I mean, we're just hit or, it's just
Yeah.
whose travel schedule.
So,
I
It
think,
would.
I think in April you have the spring break too, for those who,
yeah.
There are spring break, yeah,
There
that's
are
true,
some.
yeah.
It doesn't conflict with the school calendar,
Oh, it doesn't?
but, no.
Oh, good,
Okay.
That was handy.
that's helpful, thank you.
I don't know.
You're looking ahead, you're like.
I guess on the margin, I would say you'd want to, I don't know if you want to be going like 2 in person and zoom it out for the rest of the year. You might want to have an in-person towards the end. I don't know, I think October's,
Great.
people tend to be around more, but that's just
Yeah.
my
So
observation.
let's start with that, as Kim suggested, let's start at 50-50, let's start with this plan, and then we can adjust along the way if we need to with notice.
And we can
Um,
see at the July meeting, even though it's Zoom, how many people we could take a little stroll
Yeah.
poll, how many people were actually in town.
Mhm.
'Cause I tend to think that people go away more in August, but,
Yeah.
again, all of this is chip shouting from the chiefs.
Right, exactly, yeah.
We
never
don't know.
Okay, so we'll make that adjustment then. We'll do the July 16th via Zoom, October 15th in person. For January, we always have a secondary date, just if needed due to snow. So we've got January 9th with the 16th, which is the day after Martin Luther King holiday, as the backup. So unless there are any other comments on the schedule, do I have a motion to approve that schedule with that one adjustment for next year?
So move for the police.
Kim moves for the police.
For the town.
Eric for the town. Do we have a second?
For both.
Paul for both. Thank you so much. And all in favor? Okay, wonderful. You'll notice that we don't, before we get to the minutes, that we don't have the retirement calculations on here. Tony was not able to review them in time for this meeting. He will be reviewing them later this month, and so unless there are any comments or objections to it, when he goes to review it, he'll do a pre-approval so that we can get the payments out. And then in January, we'll formally have the information and we will vote and approve it as a board. Okay? I think we've done that in the past as well. So we'll do that. Okay. And then we have on our minutes here from July, any comments on the minutes? Let me just see who, Eric, you can't vote, I
No.
guess. Okay, so we can just approve for the police, because we don't have quorum for the town, to approve for the minutes. So do I have a motion to approve for the police? Kim, do I have a second? Paul, all in favor? Yep, okay, great. So we'll just note that for January for the town. And I know Fred was supposed to be here, but he's not here today, but
His planning and zoning meeting got moved to.
it got moved. Okay, all right. Well, he has been reelected, so will be remaining on the board until 2025. So I was going to congratulate him, but we can do that next time too. And I guess unless there's any other business, we can make a motion to adjourn. Do we have a motion to adjourn? Kim, and for the town?
Oh, yeah.
Eric, all right, and Paul Lee, second, fantastic, wonderful.
Thank you.